All right, welcome to the deep dive, everybody. Today we're going to be talking about something that I'm sure a lot of you think about a lot, and that's personal investing. Our listeners sent in some really fascinating stuff, including excerpts from, what you might call the Bible of investing, a random walk down Wall Street.
Yeah, for sure. That's a classic. And in this deep dive, what we really want to do is, pull out the core ideas from that book and give you a clear path to, making sense of the crazy world of finance and investing. You can think of this as like your guide to becoming, well, a smarter investor.
Exactly, exactly. And the book itself is pretty wide-ranging, covering everything from how the market has performed over time to like the nuts and bolts of stocks and bonds, and of course the strategies for putting it all together. I mean, it's a lot.
Hmm.
But don't worry, what we're here to do is to, sort of boil down those big ideas into, something that you can actually use, actionable insights that won't make your head spin. So maybe a good place to start is to look back and see how the market has actually done over time.
Yeah, that's a great starting point. The book kind of lays out these four distinct eras of, stock market returns. What really jumped out at you about those periods?
I think what struck me most was just how much things changed. You have this age of comfort, then it kind of flips into this age of angst, and then it's like age of exuberance, and then age of disenchantment. It's like a roller coaster.
Yeah.
But it really drives home this point that the market's not like a predictable machine, and it's always shifting and changing, reacting to all these economic forces and how investors are feeling, their psychology. And it kind of reinforces this idea that markets are cyclical.
Yeah, totally. It's like a heartbeat, up and down. And understanding that rhythm, the upswings and the downswings, it's really key to setting, well, realistic expectations, right? And the book also talks about this period, like 2009 through 2014. So it's giving you a bit more of a recent snapshot, too. These historical examples are super helpful because they remind you that market returns are never a guarantee and like boom times can be followed by, well, tougher times and then things can turn around again. Just never know.
Absolutely. So, keeping that in mind, let's dive into something really, really fundamental. How we allocate our assets. This is like the foundation of investing. And the book gives us these 5 core principles to guide us. What's like the first big idea that our listeners should grasp?
It all comes down to, honestly, one of the simplest truths about investing, which is the relationship between risk and reward. There's no such thing as a free lunch on Wall Street. If you're looking for potentially higher returns, you got to be ready for a bumpier ride.
Right. Higher potential upside usually means that, well, you're opening yourself up to more potential downside too. What's the next key principle?
Well, this one really hits on the importance of your time horizon, how long you plan on investing. It's saying that the actual risk you face, whether it's with stocks or bonds, it's not like some fixed number. It actually changes a lot based on how long you plan on holding those investments. Like over short periods, yeah, you might see some crazy swings in prices. But historically, over the long haul, the growth potential, especially with stocks, tends to be what really stands out. And all those little bumps along the way, they kind of smooth out.
So in other words, if you're in it for the long game, that long-term perspective can actually help you manage some of the perceived risk, especially with assets that have, historically shown they can grow more.
Generally, yeah. Especially when you're thinking about long-term goals like, well, saving for retirement. Now, the third principle brings up a pretty practical technique that can really help with this whole time horizon thing. It's called dollar cost averaging. How would you describe that to someone who's maybe never heard of it before, and why might it be a smart move?
Okay, so dollar cost averaging is basically about being consistent, putting in a fixed amount of money, whatever you're comfortable with, into your investments at regular intervals, let's say, every month. And here's the key. You do this whether the market is up or down that day, that week, that month. The idea is that, well, when prices are lower, your fixed investment buys you more shares of whatever you're investing in. And when prices are higher, you get fewer shares. What this does is it kind of averages out your purchase price over time. So you're not putting all your eggs in one basket at what might turn out to be, the worst possible time. Dollar cost averaging, it's not about trying to be some kind of market timing genius, which almost nobody can do consistently. It's more about smoothing out your entry point over time. And it's not just about the numbers. It's also kind of psychological, can help you feel more comfortable and less stressed about investing, which is huge.
Yeah, for sure. It's a way to ride the waves, right? To ride those market waves without having to, make these huge, potentially risky bets all at once. Now, the fourth core principle focuses on rebalancing your portfolio. What's the logic behind that?
Rebalancing. It's essentially the process of periodically bringing your asset allocation back to your original target percentages. Let's say you started out wanting, like a 70-30 split, 70% stocks and 30% bonds. But then the market does its thing and stocks have a really good run. Now your portfolio might be like 80% stocks, 20% bonds. So rebalancing would involve selling off a bit of those stocks, which have gone up, and using that money to buy more bonds to get back to your original 70-30 target. The book says that, well, surprisingly, this can actually help you manage risk and potentially even boost your returns over the long haul. It's kind of counterintuitive because it forces you to, sell what's doing well and buy what's, well, maybe not doing as well. But that's the whole point. You're buying low and selling high.
Right. It's like you're taking some chips off the table when things are good and using those winnings to buy more when things are a little bit, well, cheaper. It's all about discipline, making sure you stay on track.
Finally, that fifth principle really makes an important distinction. It's talking about, well, your attitude toward risk, like how comfortable you feel about potentially losing money and your capacity for risk, like your actual ability to withstand those losses based on your financial situation. Things like your income, your expenses, and how long you have until you actually need that money.
Yeah, that's so key. It's easy to think, oh, I just want to avoid all risk. But if you're, younger and you have years and years until you retire, you might actually be able to handle more risk than you think, even if it makes you a little nervous. You got to kind of balance your gut feeling with, the cold, hard reality of your financial situation and your goals. And speaking of goals, the book also walks you through how to build an investment plan for different stages of life. Where does it start? Well, the first big takeaway is that, different financial goals, they need different assets that make sense for, well, how long it'll be before you need that money. It's like if you're saving for a down payment on a house and you need that money in a year or two, you don't want to throw that into the stock market. I mean, who knows what could happen? You need that money to be safe and easy to get to.
Right, right. So you got to match your investments to your goals and, when you need that money. Now, what else does the book say about building wealth over time?
It goes back to that idea of risk tolerance, knowing yourself and how much risk you're actually comfortable with. And then a really crucial point, maybe the most important one, is the power of consistent saving. Putting money away regularly, even if it doesn't feel like much at first. The book actually quotes Einstein, of all people, talking about how compound interest is like this eighth wonder of the world. And it gives this wild example of, that $24 that was used to buy Manhattan Island back in 1626. Imagine if that had just been invested at a measly 6% interest, compounded every 6 months. Well, guess what? It'd be worth trillions today. I mean, it just shows you how much compounding can snowball over time.
Wow, that's crazy. Okay, so even small, regular contributions, they can grow exponentially over time thanks to the magic of compounding. Got it. Now, the book also briefly mentions these things called life cycle funds. What are those all about?
So life cycle funds, they're also called target date funds. They're basically like, all-in-one investment portfolios that automatically shift their asset allocation over time to get more conservative as you get closer to, well, a specific target date, which is usually your planned retirement year. It's kind of like, set it and forget it, a handoff approach for people who don't want to be constantly fiddling with their investments.
Okay, that makes sense. It takes some of the guesswork out of it. Now, the book also touches on, what to do with your investments once you actually hit retirement. What are some of the key things to keep in mind?
Yeah, it talks about how, unfortunately, some folks just aren't really prepared financially for retirement. And for those who have built up a nice nest egg, it talks about different strategies for investing that money so it can generate income, to keep things going throughout retirement. This includes looking into things like annuities, which can provide a steadier stream of income, and also, the option of just continuing to manage your own investments if you're comfortable with that.
Right, so there are different options depending on your situation and, how much you want to be hands-on. Okay, so moving on, the book has this section called 3 Giant Steps Down Wall Street, which I love. The first one is called the no-brainer step. What's the main advice here?
This is really where the book lays down its central philosophy, which is, investing in these things called index funds. And the argument is basically this. The stock market, for the most part, is really good at pricing things fairly. This means that it's super tough, almost impossible, for most professional money managers to consistently beat the returns of the overall market, to do better than just the average. And the book even points out that over time, something like 2/3 of these pros have actually been outperformed by plain, simple index funds that don't even have a manager.
Wow, that's pretty amazing. Okay, so for those of us listening who might not be total finance nerds, what exactly is an index fund, and why does the book make it sound like such a smart and easy choice.
So an index fund, it's a type of mutual fund, or ETF, which stands for exchange traded fund. And what it does is it aims to match the performance of a specific market index, which is like a benchmark, something like the S&P 500. And to do this, it holds a really diversified portfolio of stocks that basically mirrors whatever's in that index. And because it's passively managed, meaning it just tries to copy the index and not try to outsmart the market, it usually has super low fees, especially those management fees that can really eat into your returns. Now, ETFs, those exchange-traded funds, they often offer that same kind of broad diversification as index funds, but sometimes they can be even more tax efficient because of how they're structured.
Okay, so low cost and broad diversification. Sounds like a winning combo. Now, the second giant step is called the do-it-yourself step. For those who might be, tempted to try their hand at picking individual stocks, what advice does the book have?
Yeah, if you're feeling adventurous and want to try your luck at stock picking, the book gives you 4 rules to keep in mind. First up, focus on companies that look like they have the potential for, above average earnings growth for at least the next 5 years. You're looking for those growth companies where, not only are their profits going up, but the market's valuation of those profits is also increasing. It's like a double whammy.
So it's about finding companies that are, on a solid upward trajectory,
Yeah.
that have room to grow. What's the next rule for the DIY investor?
Rule number 2 is all about value. Don't get caught up in the hype and overpay for a stock, no matter how amazing the company seems. A great company doesn't automatically equal a great investment if the price is already way too high. You want to make sure there's a solid foundation of value there, that the price you're paying is justified by the company's fundamentals.
Right, so don't let emotions take over. Look for real value. What else should DIY investors consider?
This one's interesting. Rule number 3 acknowledges the power of, market psychology. It says to think about stocks that have these compelling growth stories, narratives that can capture people's imagination, and potentially lead to, a surge in demand. The book calls this castles in the air.
So it's about understanding how sentiment, how people feel about a company, can actually drive prices, but hopefully grounded in some real potential. What's the final rule?
This one's simple, but a lot of people forget it. Rule number 4, trade as little as possible. Every time you buy or sell a stock, you're paying fees, and those fees can really add up over time and eat into your returns.
Yeah, that makes sense. Keep those transaction costs down.
Yeah.
Now, that third giant step is called the substitute player step. Who are these substitute players?
These are the pros, the professional investment advisors who you can hire to manage your money for you. And the book recommends resources like Morningstar, which is great for researching mutual funds. And, if you want to find an advisor, it's a good place to start.
Right, so it's saying that, well, for some folks, having someone else handle their investments, it just makes sense. Now, there's also this thing called the Malkiel step. What's the big idea there?
This step brings us back to that core idea from the book, the whole random walk theory. It's basically saying that even if you follow all those stock picking rules perfectly, a big chunk of your success or failure is still going to depend on, just random stuff, things that you can't control. The book makes this funny comparison, it's like a chimpanzee blindfolded throwing darts at a list of stocks. That chimp could pick a portfolio that does just as well as, some expert on Wall Street. It's a way of showing how unpredictable the market really is and how hard it is to constantly be right.
Okay, so even with the best research and strategy, there's always an element of, luck involved. Got it. So let's take a little deeper into those concepts you mentioned earlier, the firm foundations and the castles in the air. What's the difference between these two approaches?
This really gets at the heart of 2 totally different ways of thinking about investing. Firm foundations investing, it's all about looking at the actual tangible value of a company, things like their assets, their earnings, their dividends, stuff you can measure and analyze. Castles in the air, on the other hand, it's much more driven by psychology, how investors are feeling, and this belief that some company is going to grow like crazy in the future, even if there's not a lot of proof yet. It's all about stories and speculation.
Right. One is about what a company is worth right now. The other is about, what people think it might be worth someday. And the book actually has some pretty scary stories about what happens when people get too carried away with those castles in the air.
Yeah.
Okay?
Oh, yeah. It goes through this whole history of speculative bubbles, and it's pretty wild. I mean, you've got the South Sea bubble way back when, the crash of '29, the conglomerate craze in the '60s, these so-called concept companies with inflated valuations, and of course the whole dot-com bubble with all those scandals and, Enron collapsing. It's like a cautionary tale about what happens when, well, when people get irrational and greedy.
Yeah, it's a good reminder that history does repeat itself.
Yeah.
What about when companies first go public? Those IPOs. What does the book say about those?
Well, it says to be really careful about, jumping into those hot new IPOs.
Yeah.
The data shows that most of them actually underperform the overall market in the long run. And if you wait to buy in until after that initial hype, when the price has already shot up, your chances of making money get even worse.
So it's better to be patient and, maybe let things settle down a bit before you jump into a new IPO. Good advice. Now, another important topic the book explores is the difference between technical analysis and fundamental analysis. Can you break those down for us?
Sure. So technical analysis, it's like trying to predict the future of stock prices by looking at, past market data, mainly price movements and trading volume. Technical analysts, they're always looking for patterns on charts like, that famous head and shoulders formation, hoping that these patterns will tell them which way the price is going to go next. Fundamental analysis, it takes a different approach. It focuses on figuring out what a stock is actually worth, based on the company's financial health, its business prospects, the industry it's in, and, the overall economy.
So one is all about charts and patterns, and the other is about, digging into the nuts and bolts of a company's finances and its potential. What does the book say about how reliable these approaches are?
Yeah, so the book is pretty skeptical about technical analysis actually working. It says there's really not much evidence that past price movements can tell you what's going to happen in the future, which kind of goes back to that random walk idea. It even has this funny story about, a chart that was generated from just flipping a coin a bunch of times, and it ended up looking like a really bullish signal to a technical analyst. It's a good point that just because you see a pattern doesn't mean it actually means anything.
Right, sometimes a pattern is just a pattern. So what about fundamental analysis? Does the book like that approach better?
It does say that fundamental analysis is, a more logical way to try and figure out if a company is going to do well over the long term. But it also points out that it's really, really hard to accurately predict how much a company's earnings are going to grow, which is kind of the cornerstone of this whole method. There have even been studies comparing, those fancy analysts' earnings forecasts to simple statistical models. And guess what? The analysts didn't always do better. So the book's main advice is to use fundamental analysis to, find those financially healthy companies, but don't fall in love and overpay for them no matter how good they look on paper.
Makes sense. So it's good to do your homework, but don't get carried away. Got it. Now that brings us to this concept of the efficient market hypothesis, and then there's this whole field of behavioral finance. Can you unpack those for us?
Yeah, the efficient market hypothesis, or EMH, it basically says that the current price of a stock already reflects all the information that's out there. So if that's true, it means that it's basically impossible to consistently beat the market, to get better returns than the average investor. But then you have all these crazy things that have happened, like the crash in '87, the dot-com bubble, and the 2008 financial crisis. And these events have made people question if the EMH really holds up all the time. And that's where behavioral finance comes in. It looks at how our psychology, our biases and our emotions can actually influence how the market behaves. And sometimes it makes things, well, not so efficient. It looks at things like herd behavior, that tendency to just follow the crowd, and loss aversion, which is this idea that the pain of losing money is way stronger than the joy of gaining the same amount.
Right. It's like our brains aren't always wired for perfectly rational decision-making, especially when it comes to money. So given those insights from behavioral finance, what practical advice does the book offer for us regular folks?
It gives some really good tips. First of all, watch out for herd behavior. Just because everyone you know is talking about some hot stock doesn't mean it's actually a good investment. Second, be extra careful when you hear, everyone being super positive and agreeing about an investment. That could be a sign that things are getting bubbly and, well, a crash might be coming. And then here's a weird one. Because we hate losing money so much, the book suggests that if you're gonna sell investments, you should actually be more willing to sell your losers, not your winners. It's counterintuitive, because we usually hold on to those losers hoping they'll come back, but we're quick to cash in on our winners.
That is interesting. It's like fighting against our natural instincts. The book also talks about these smart beta strategies. What are those all about?
Smart beta, It's kind of a newer set of strategies that are trying to do better than those traditional market cap weighted index funds. And they do this by tilting their portfolios towards certain factors that historically have shown that they might give you slightly better returns, things like value, momentum, or low volatility. But the book says that, well, we're still waiting to see if these smart beta strategies actually work consistently over the long term.
Okay, so it's still up for debate. Got it. Now let's move on to something that's super important. Managing risk and building a diversified portfolio. The book keeps coming back to this idea of risk and reward being linked, and it often mentions the Ibbotson data. What does that data tell us?
The Ibbotson data, it basically shows that over long periods, those assets that have delivered the best average returns, things like small company stocks and large company stocks, they've also had the biggest swings in price from year to year. So more potential reward, but also more risk in the short term. And on the other hand, you have those investments that have lower returns, like treasury bills, and they've been way less volatile. It's like a classic trade-off. If you want the chance to earn more in the long run, you usually have to be ready for more ups and downs along the way.
Right, that makes sense. Higher returns often come with a bumpier ride.
Yeah.
And like we were talking about earlier, the book makes this point that the risk of investing in the stock market, it actually goes down the longer you hold onto your investments. Why is that?
It's because over longer periods, all those short-term ups and downs, they kind of get smoothed out, and the long-term growth trends, especially with a well-diversified portfolio, become much more important. And that's why stocks are generally seen as a good choice for those long-term goals, like retirement. And speaking of diversification, the book really pushes that as a key strategy. Why is it so important to spread your investments across different asset classes?
Diversification, it's basically your best weapon against this thing called unsystematic risk, which is the risk that's tied to a specific company or a specific industry.
Yeah.
By having a mix of different assets that don't all move in the same direction at the same time, you can smooth out your overall returns and, cushion the blow if one of your investments goes south. This is a big part of what's called modern portfolio theory.
Yeah.
The book also mentions the CAPM, the capital asset pricing model. What's that all about?
CAPM, it's basically a model that tries to explain how much return you should expect from an investment based on how much systematic risk it has. And systematic risk, it's the risk that you can't get rid of through diversification. It's like the overall risk of the market itself. And they measure this risk with something called beta, which tells you how much a stock's price tends to move compared to the overall market. But the book does say that CAPM isn't perfect and, it doesn't always predict real-world returns accurately.
Right, it's a model, so it's a simplification of reality. Now, besides your main investments, like stocks and bonds, what else does the book say about managing risk and building financial security for the long haul?
Well, it really stresses the importance of having enough cash on hand for those unexpected expenses. That old saying, cash is trash. It doesn't really apply when you have an emergency. Everyone needs a safety net. It also talks about having the right insurance coverage, to protect yourself from those big life events that can really throw your finances off track. And then it gets into the benefits of using those tax-advantaged retirement accounts like traditional and Roth IRAs and those employer-sponsored plans, and also those 529 plans for education savings. It even gives a clear example showing how much of a difference those tax breaks can make over time.
Yeah, those tax benefits can really add up over the years. The book also talks about other assets like real estate and bonds. What's the main takeaway there?
For real estate, it says that owning your own home, it can be a solid investment for a lot of people. And it also mentions REITs, those real estate investment trusts, which can be another way to add diversification to your portfolio. When it comes to bonds, it says they can help diversify your portfolio and also be a good way to fund future expenses. It specifically mentions zero-coupon bonds, which can be useful for that. And it advises investors to stick with those low-load bond funds to keep costs down.
Okay, so a mix of different assets is key. Now, are there any types of investments that the book says to avoid?
Yeah, it's pretty clear about steering clear of, collectibles and those fancy, often complicated investments like hedge funds. Unless you're a super sophisticated investor, collectibles are more of a hobby than a reliable investment. And hedge funds, well, they usually come with high fees, and they haven't really proven that they can consistently deliver those amazing returns they promise. And that brings us back to one of the book's main points. Investment costs, those management fees and trading expenses, they have a huge impact on your returns. So it's almost always better to go with those low-cost options like index funds.
Right, low costs are key. Now, the book also talks about this tricky question of trying to predict future investment returns. What are some of the things that it says could impact how the market performs in the future?
It points to three main factors: how much the market is currently yielding in dividends, the long-term growth rate of corporate earnings, and any changes in that price-earnings multiple, which is a way to measure how much the market is valuing those earnings. And it uses examples from the past, like the booming 80s and that, tough lost decade of the 2000s, to show how these factors can play out in real life. And it also reminds us that historically, stocks have tended to offer higher returns over the long term than bonds.
Okay, so there are these big picture factors that can influence returns,
Mm.
but it's really hard to predict exactly how they'll all interact, which kind of brings us back to where we started with those index funds. What are the key benefits of just sticking with those?
The main advantages are pretty clear. They have much lower fees than those actively managed funds. They have lower trading costs because they don't buy and sell as much. They can be tax efficient. And historically, they've actually done better than most of those active managers over the long term. The book even suggests that if you really want to try your hand at picking individual stocks, you should still use index funds as, the foundation of your portfolio just to get that broad diversification and keep costs low.
Sounds like a pretty solid strategy. So as we wrap up this deep dive, what's the main takeaway, the most empowering message that the book leaves us with?
The most important thing it says is that regular investors, people like us, we can actually make sense of Wall Street and be successful investors. You don't need to be some insider, you don't need to know any fancy trading tricks, and you definitely don't need to be able to predict the future. What really matters is understanding a few core principles, taking that long-term view, building a diversified portfolio, keeping costs down, and being aware of, our own psychological biases that can mess things up.
Exactly. Yeah. And probably the most important lesson of all is the incredible power of compounding and consistent saving. Putting money away regularly, even if it's not much, that's what really builds wealth over the long term.
Absolutely. So here's a final thought for you to chew on. Based on all this historical data and these insights into how the market works and, well, how we as humans think about money, how might you change your own investing approach? And what questions do you now have about building a strong and, prosperous financial future? We encourage you to really think about these concepts and maybe even do some more research on anything that piqued your interest. Thanks for joining us for this deep dive.
Yeah. Thanks for listening, everybody.